Hey, Daryl. So yes, that was 8 to 12 till I get more on the property. Until I price it out with my investors and underwriters. 8 to 12 on the investment, and yes, length of time. But as far as term, it would be a 30-year term, regular 30-year amortization. That's what we would do. They could do interest only in the beginning part to 10 years too on the commercial. So we could do that as well. But it all depends on what the client wants, what they have to put down, credit score. A lot of it goes into the commercial, but a 52, if my memory serves me correctly, 52 unit apartment building. Yeah, that's right up our alley, man. That we could do all day long. And with that being said, I want to welcome everybody to our installment on home equity loans. Now, home equity loans are becoming very, very popular. Why? Because it helps keep or preserve the first mortgage. So when you get a home equity loan, it is a second loan on your home. All right, you do not touch the first mortgage. It stays intact. And why would you want to touch your first mortgage when I believe the average rate to people that refinanced is, I've seen as low as 1.99 on some VAs in the past, 4 years. I've seen as high as maybe 3.875. And the current rates right now are 6.5, I think, on a 30-year fixed was the national average today. So not going to go from, let's say, worst case 3.5 to 6.5. Payments would go through the roof. It's not worth taking the cash out. However, in order to preserve your first mortgage, you can go and get a home equity loan. And that's what we do. We do home equity loans, guys. I don't have lines. That is something that a lot of the bigger banks do, and a lot of them have canceled it. I know Chase is not doing them anymore. I don't believe Citi is doing them anymore. A lot of the big banks have backed out of that product, as well as ceasing some mortgage operations because the rates have just gone high and the business is not there for them. Not the case for us. We're still thriving. We're still closing a lot of DSCR loans. We're still doing a lot of regular loans. People are still buying, guys, especially here in New York. So with my little intro done there, I want to share my screen and start with the presentation, guys. So what is a home equity loan? Home equity loan is also known as a second mortgage that enables you as a homeowner to borrow money by leveraging the equity in your home, and the loan amount is dispersed in one lump sum and paid back in monthly installments. That's a home equity loan in a nutshell. Very, very brief overview, team. Okay. Now, there's something called combined loan to value. What is combined loan to value? It is the combination of the first mortgage and the second mortgage, and you come up with a combined loan to value. Okay. So if you want to read the screen there, I gave you a couple of examples, or I gave you an example of what a combined loan to value is. We use that to assess the risk. Obviously the higher the loan to value, meaning the less equity left in your home. Okay. So the less equity left in your home, the higher your interest rate, obviously the higher the risk. Take a look at the example down there. All right. So for example, property has two mortgages, one with a balance of 150,000, another with a balance of 50. The property appraised for 300,000. The combined ratio would be calculated as follows: 150,000 plus 50,000 divided by 300,000 gives us just about a 67% combined loan to value, which is great for us. We like to keep it at 80. We do go up to 90, which I'm going to cover in another slide. But again, that is something we figure out. There's no such thing anymore as 100% loan to value, or back in the day, some banks like Bank of America was lending up to 125% of the combined loan to value. Not the case anymore, guys. And ladies and gentlemen, it is capped anywhere from 80 to 90 across the board, depending on how the property is dispositioned. And I'm going to get to that in a few slides. All right. Key highlights: loan amounts up to 350,000, minimum FICO over 660, compared to, again, your Bank of Americas that are still doing them, your Bethpage Federal Credit Unions, where you have to prove income using your tax returns, W-2s, pay stubs, or your self-employed tax returns. If you are self-employed, not the case here, guys. And you need usually a 720 to a 760 just to even for them to consider you. My team, my underwriters, my bank, and again, this is my bank, we're banking it under in here in-house, goes to a 660 FICO minimum. I don't need to show any reserves, meaning mortgage payments in the bank after all said and done. So zero reserves mean you do not have to show any money in the bank. Your ending balance could be positive $100. Does not make a difference to my underwriter. Okay. Full documentation of income. By full documentation, I mean putting all your cards on the table, pay stubs, W-2s, tax returns. If you're self-employed or 1099, I need that Schedule C or your business tax returns in order to get you approved. Bank statements now. Here's what makes me different than the banks. I can go bank statements like a regular non-QM mortgage that we have, and I can go up to 85% of the combined loan to value of your home. So what does that mean? If your house is worth, again, I'm going to use simple numbers, guys. If your house is worth $100,000, I could do both loans combined of $85,000. So if you have a house that's worth $100,000, if you owe $60,000 on your first mortgage, I can get you a maxed out mortgage if you're using bank statements of another $25,000. In addition to the debt to income being 50%, meaning half of your income to go to all of your bills. Again, you walk into one of the bigger banks, they want you around a 43% of your income, sometimes 38% on the home equity lines of credit, because it is a riskier product for the banks, because it is a second mortgage, and they have a higher default rate. And we all know a higher default rate means a higher interest rate. So keep that in mind, guys. The interest rates are higher on a second mortgage because it is a higher risk. The more risk, the higher the rate. Now, here's another thing that makes us different than the banks. I can go NOO, or non-owner occupied, again, an investment property, which is huge. That, to me, that makes me excited. We're closing these a lot because the home equity loans on a investment property, guys, is pretty big. Why? Not many banks do them. And also, investment properties have low rates too over the past couple of years. So a lot of investors are taking advantage of this. They're keeping their low rate first in order to get some equity, and they're buying other properties. I have a lot of realtors that are coming to me. Hey, my client needs some more down payment money. Just like we discussed last time, a lot of the loan to values are coming down on these DSCRs. A few months ago, you could get away with 85% on a DSCR loan for investors. Now, the average LTV, or the average down payment, is around 25%, and they raised the bar on credit scores. So they're leveraging their investment properties to take out some cash to buy another property and bridge the gap for that extra 10 or 15%. So we're still getting people with 660s into investment properties, team, because we're leveraging either their bank statements to bridge the gap or another property to get that down payment money. So there's a lot of ways we can structure these loans to get investors in. And a lot of people are seeing investment opportunities and leveraging a little bit money from their primaries, because I think the last stat I saw, there was either, $5 to $7 trillion in equity outstanding. It's probably go down, even if it's $4 trillion with the way houses are going down. That's still a ton of equity to be accessed. It's a lot of loans out there, team, a ton of loans that can be gotten. And like I said, this is our second most popular product behind the debt service product. Okay. Next exciting thing, and next thing again, which is helping a lot because the values were still very high last year. So the appraisal, you have somebody that had an appraisal done a year ago, just refinanced a year ago. I can use that appraisal. They do not have to pay for another appraisal. They may have to pay, a couple of $100 to have it recertified or to get a clarification that we need from the old appraiser, but you could use the old appraiser, which saves time and that saves money. Okay. And again, team, just put the questions in the Q&A as you come up with them. You don't have to wait to the end. Load me up in that Q&A. I'll be through the slides in a few more minutes. But again, load me up in the Q&A. This way I can answer as many questions as you guys have. And I want you guys to come away very confident from this product. And you know what I say, the more you know, the more confident you are. The more confident you are, the better you can convey the product. The better you convey the product, the more you can sell. Okay. A HELOC versus a HELoan. What's the difference, guys? You guys can read that, but I'm going to sum it up in a nutshell for you. A line of credit that uses your house as collateral. So it's basically having a credit card against your house, but here's the difference. Your limit is much higher, anywhere from $25,000 to I've seen up to $500,000. Now, you don't pay unless you take money, and it is usually an interest-only payment for the first 10 years, in addition to being an adjustable rate that is usually based on the prime rate right now. Now, these were very popular up until 6 to 8 months ago because prime was just about zero. Now prime is in the sevens. They raised another quarter the other day. So prime is up there, which brings me to loans. Here's the loans. With a loan, you get all of the money up front. Your payments start immediately. It's a lump sum in your bank account after you close. You have no more access to the money, and you start paying it back immediately. You start paying back with principal and interest anywhere from 20, or you could do 15 actually, to 30 years. Most people opt for the 30-year because they want the cheaper payment. And again, you get all the money one lump sum to do with at your disposal. You could do a bunch of stuff with the money. You could pay off high credit card debt. You could use it to put your kids through college, buy work vans or work cars, trucks, a car for yourself, whatever the case may be. We really don't have any restrictions on the money. Okay, so eligible properties, not much here, guys. Strictly for residential properties and condos and non-warrantable condos. So pretty much condos and 1 to 4 unit residential properties, whether they're owner occupied, second homes, or your primary residence. I'm sorry, or your investment property. So that's what we can do, and that's what we could use as collateral. So here's a couple ideas of what the money can be used for. Pay off your high interest credit card debt. Most credit cards are at 24 to 32%, I believe. You could cut that debt down, okay, by getting a 30-year loan fixed anywhere from 9 to 12% on a second mortgage. You could use real estate investing for the renovations, okay? Purchase a new vehicle or pay for your kids' college tuition. So there's a lot. Again, these are just some examples. Sky's the limits. You know, again, really no restrictions on the money. You're getting all in one lump sum. You could do with it as you please. So again, these are the types of occupancy you could put them on. Primary, a second or vacation homes, and investment property. Again, very simple, guys. It's a simple product geared towards residential properties. I don't have any commercial equity loans right now or lines. You know, those are very few and far between for me, at least. But I do have access to home equity loans on investment properties, primary residences, and second/vacation homes. So that's really it, guys. That's all on a home equity loan. Start piling me up with those questions. Very, very, very simple product. You know, to review, $660 to get in. You could use the money for just about anything. You can do it on an investment property. You could do it on your second home. You could do it on your primary residence. Okay, we are capped at loan to value. The max combined loan to value is 90% if it's a primary, and I can prove your income. The lowest is 75% on an investment property. Max loan amount $350, $660 to get in, guys. Here's my contact information. Start loading me up on the Q&As team. Let me know what questions you have. I'm going to leave my slide up there for a little while. Just scan that QR code. All my information will come up. Let's see what kind of questions we have. Okay. We get a copy of this PowerPoint. Elliot, I do not send out copies of my PowerPoints. I do have some marketing material I can send you for you guys to do, but we don't send out copies of our PowerPoints. What is the payout for investment property? No doc. Michael, please define the payout. Do you mean rate? If you mean the rate, you know, we don't do a no doc loan. You still need to prove income, whether it's bank statements or traditional ways with W-2s, pay stubs, tax returns. The closest thing I have to a no documentation income is a bank statement loan on this, meaning, Michael, you could discuss that with me later with the ISO. You know, everybody has their ISO agreement. We pay the same on them, but you can contact me privately for that. Again, full doc, no doc is not the same. We don't have a no doc loan team. Okay, the closest thing I have to a no doc on this product is a bank statement, using bank statements as income. Now, if they can't use bank statements, they still need an income of a property. We could weigh out the financial benefit and tangible net benefit to the borrower. If they want to use the entire DSCR program or refinance the whole mortgage, we can look at that. Hold on, Michael, just let me catch up here, bud. How many months of bank statements? 12 months. 12 months we could use. And what are the rates? Anywhere from 9 to 12%. Again, all depends on how much equity is left in the house, the credit score, if it's a multifamily, if it's a condo, if it's any of those. It all has to do with that. And again, you bring me scenario by scenario, and we can price it out for you properly. That's it, team. No more questions. Let's see. We have anything on IG Live? CM Bolos, Apex joined. Nope, there's nothing on the question. So I guess that was simple. I guess it did that job. You guys are experts in home equity loans. Again, team, I only do home equity loans. I do not do home equity lines. Okay. Again, home equity lines is something that the banks keep to go into, it's something they use to advertise to get people into their banks. But like I said, I know Chase is not doing them anymore. Citibank, a couple of other big operations, Wells Fargo, a lot of them have stopped doing home equity loans. I don't know exactly who's left because I feel like that's changing every day. But again, team, home equity loans. Let's see, we got another Q&A. What is the difference between home equity loan versus home equity lines? Michael, again, home equity loan, get all the money up front. Home equity line is a line of credit against your house. So lines of credit, you only pay on what you use. You only sometimes pay. Some banks have a yearly service fee. I've seen as low as $89. I've seen as high as $500 in my career. But again, I don't do lines. I only do loans. Lines, I feel like, are very risky because, like I said, all of the big boys are cutting them out. Correct. We only do loans, Michael. We only do loans. All right. We don't do lines right now. We only do loans. Lines, are available to mortgage bankers. And again, I'm the underwriter. I am the bank. It does not leave house. I do not broker it out. I am not a broker. I am a bank. Okay. When it comes to this product, I am the bank. It goes to my underwriters, goes to my processors. It stays in the house with me, Manny DeMonte. It does not leave. All right. And we make the decision and we make it quickly. Current turn times, guys, right now for answers on anything that is in house is about 48 hours. Average loan in about 21 days on a refi. A little bit longer on a purchase. These can be used for purchases too, but it's very rare. But again, guys, that's the difference between a line or a loan. Reach out. I'm going to take my contact information off. I'm going to stop the share. As usual, I want to thank everybody for chiming in, jumping in for the questions. Last minutes here, guys. If you have any other questions, let me know. If not, contact me privately. I am here always. I got a few more loans to put in now. Daryl, if you're still on, let me know. 9 o'clock, we could do it. If he wants to do earlier, we can. 8:38, it doesn't matter to me. Hit me up whenever. I'm available. I still be in the office, have a few more loans to catch up on. But again, guys, thank you all for tuning in. Next week, I'm going to have a special guest realtor on. She's going to tell everybody, some tips on their house, selling maintenance, buying maintenance, what to look for, what to stay away from. So we're going to change it up. You guys don't have to see this mug all by myself next week. You get to see my friend Mercy Roman, a personal friend and a realtor that I use and I refer clients to. She will be here next week telling us about the realty market, what she's doing for her clients, and how she's getting offers accepted in at least New York here, where it's still somewhat of a seller's market. All right. Everybody be safe. Go back to eating your dinner. If you're on the West Coast, got a few more hours left to make those phone calls, call clients. I'll speak to everybody next Monday. Tune in for Mercy and to her commentary on realty. Speak to you all soon, and thanks for tuning in, team.